Morning, this is Andy Cates from the Global Economics Department at UBS. The pernicious environment that's been plaguing markets over the past few sessions has, for the time being at least, brightened a little in Asia overnight. Equity markets across the region have mostly bounced off their lows, led in the first instance by a sharp recovery in Korea and Hong Kong, which then spread to Australia, Taiwan and Japan. It is, of course, extremely difficult to argue that markets are trading off fundamentals right now, and a fundamental catalyst for these moves is therefore equally hard to find. Some are attributing the bounce to comments from Japan's finance minister, who was quoted as suggesting that his government would respond to stock market weakness. Others, though, are citing market conjecture concerning a rate cut in China. The fate of US automakers and Citigroup, meanwhile, remains a dominant, if not the dominant, short-term issue that many in the markets are focusing on. A Wall Street Journal report today suggests that many of Citigroup's executives are considering the possibility of auctioning off pieces of the bank or even selling the company outright, with a couple of other well-known US banks reported to be possible partners. Otherwise, as far as fundamental news flow is concerned, the Bank of Japan, for the record, left rates unchanged last night, in line with expectations. The statement released alongside this decision suggested that Japan's monetary officials, like its government officials, had been talking about other ways of providing support via the provision of greater liquidity in the money markets. And it's the provision of liquidity by central banks which is another fundamental topic for discussion right now, and will, of course, remain so all the while deflation fears are as entrenched as they appear to be. Note here on that score that the nominal yield on US Treasuries is roughly the same as it is on 10-year tips, suggesting that the market is anticipating next to nothing by way of average inflation in the US over the next 10 years. Whether or not the Fed and other central banks are engaging in so-called quantitative easing or not it is still fairly easy to forecast against the current backdrop that further aggressive steps will be taken by central banks to pump money into the system in order to boost demand. A global financial crisis, the bursting of a massive commodity price bubble, combined with pernicious financial and household deleveraging, will certainly deliver much lower levels of inflation in the period immediately ahead. A period of entrenched deflation will probably require a great deal of policy error, however, in the coming months. Finally, in the day ahead, for the record, the data calendar is fairly light in the US, though a number of Fed speakers are on offer. Europe sees some provisional purchasing manager surveys of both manufacturing and services, with a further drop in sentiment expected from already depressed levels. That's all for today. Thanks very much.